Hello, this is Will Allen with Centera Capital. Last week, the stock market had its best week of the year, and today we're going to take a look at the factors that led to that rise. Those included the Treasury Department's quarterly refunding announcement, the Federal Reserve's decision on interest rates, and we're also going to revisit a post we had on October 7th about seasonality. But before we get into that, we just want to remind you to like and subscribe to our channel, and don't forget to turn on notifications where you see the bell below. Now let's get into it. Last week, the S&P 500 was up over 5%, which was its best weekly gain of the year. We're going to talk about the factors that led to that increase, and they include the Treasury Department's quarterly refunding announcement, the Federal Reserve's decision on short-term interest rates, and we're also going to revisit the role that seasonality is playing in the markets right now. So let's start with the quarterly refunding announcement. As I said in our market update last week, this is something that up until 3 months ago was not even on the radar screen of most investors. The Treasury Department every 3 months give an announcement of how many Treasury bills and Treasury bonds they're going to issue for that 3-month period. And if you will recall, on July 31st, their announcement that they were going to issue over $1 trillion in the third quarter is what led to a major decline in stocks over the next 2 months, as well as a moonshot for long-term interest rates. So last week, what we got from the Treasury Department, they gave their announcement for the fourth quarter, and it came in at $776 billion, which that is a lot of money, but it is less than what their first estimate was for the fourth quarter, which was $850 billion. So the stock market went up on that news, and more importantly, interest rates on long-term rates, 10-year Treasury, went down. So let's take a look at this chart. And this is of the 10-year Treasury yield, and you will see that this had peaked right at 5%. Going back about 2 weeks ago, up from 3.97% on July 31st. So it had gone up a lot. Well, take a look over the last week. This has declined to right at 4.5%. That is a nice decline. And one area where this is going to help the economy is on mortgage rates. So we'll put up a chart here that shows that the interest rate on a 30-year mortgage, which had gone to over 8%, up from 3% just a year and a half ago. This has declined to under 7.5% currently. So it was at 8% last week. Interest rates went down on the 10-year Treasury, and it is at 7.5% now. Okay. That is the Treasury Department's quarterly refunding announcement. The other big piece of news last week was that the Federal Reserve made the decision to keep overnight interest rates the same, right at their range of 5.25% to 5.5%. So they made the decision, interest rates, they're not hiking, and even better, their projections, the market at least is projecting that the Fed is not going to do any more rate hikes. And in fact, in mid-2024, they're pricing in that the Fed will begin cutting interest rates. Now, we don't know if that's going to be the case or not, but in the short run, it is really good news that it appears that the Fed is at the end of their rate hiking cycle. We certainly believe they should be at the end. They should not be hiking anymore. But that is something that last week really led to further rally in the stock market when the Fed made it clear we're not hiking now, and we're likely not going to hike here in the months to come. Now, I want to come back to a point we first made on October 7th about seasonality. And we talked about the fact that it was very normal for the stock market to have a decline in the August and September timeframe, that had happened now 5 years running. But we mentioned that if you went back and looked at the last 5 years, that the stock market, once we got into October 1st through December 31st, the fourth quarter, the market had done very, very well. In fact, going back 10 years, the stock market has been higher in the fourth quarter 9 of the last 10 years, and the average gain in those 9 years is over 7%. That is a tremendous return in just one quarter's time. Now let's put back the chart of the S&P 500 from October 1st of this year up through yesterday, November 8th. And you will see the S&P 500, after having a decline in mid-October, where it looked like the seasonality factor was not working in our favor this year, last week's gain in the stock market now has the S&P 500 up over 2% now since October 1st. So we are back on track for gains for the fourth quarter as the stock market looks to make it 10 of the last 11 years being up in the fourth quarter. One last thing I want to leave you with is an update on the earnings picture, because we're almost through the S&P 500 earnings outlook for the third quarter. And right now, earnings are up over 10% year over year compared to the third quarter last year, if you exclude the energy sector, because that is fairly volatile, goes up or down. We like to look and see, okay, what's happening if you set that aside. And the 10% earnings gain is much better than what was anticipated just a month and a half ago, when analysts were projecting earnings growth of 5% if you exclude the energy sector. So earnings news has been much more positive than analysts were expecting. That is really good to see. Now, just as a reminder, like and subscribe to our page here on YouTube. Don't forget to turn on the notifications with the bell there. And again, we're going to keep you updated with more content almost weekly from here on out. We hope you enjoy it. Send it to your friends if you haven't already, and we appreciate you doing that. Take care and have a good week.